Okay, so in the interest of time, I think we can start. For those who just joined us, I had introduced myself as Linda Makatiani, your host for today's webinar. I am a financial literacy trainer, a family wealth planner, and an investing coach. What that basically means is I get you to understand your personal finances. So I get you to understand from budgeting, managing your money, to saving your money for the future, to investing, and I walk that journey with you. So I call myself your accountability partner, and as well looking into ways to protect the investments that you've made. So today we are looking at how can we grow our wealth beyond just thinking that wealth means we have to have a home standing somewhere, So karibuni sana. I had shared a bit about myself on the chat as well, and some links on the socials that you can find me on, just two of the main ones, my Instagram and my LinkedIn. And I've shared as well my number and my email address. But as we start off, allow me as well to just say thank you to the VUKA team for coming through and collaborating on this session. And we'll cover just a bit about VUKA as well as we go through. But as I said, today's webinar is about us looking at how can we grow our money without really looking at that we have to have a home. And what we're going to go through, we're going to look at the opportunities that are there, what strategies can we build, and then those insights, I am hoping we'll be able to turn them into actions so that we can fully realize the benefit of what we are talking about, the benefit of now creating that wealth, right? So I just want us to start with this statement that owning a home doesn't automatically mean you're building wealth. Yeah, just because I have an address that I have the key and it belongs to me, I have the title deed, it doesn't mean that I'm building wealth. And the reason why we say this, or at least I say this, is the first thing, a house, that home, is often a liability before it becomes an asset. Now, a liability is something that you have that takes money away from you. So if you think about it, if it is land that you have bought and you are constructing, then it is taking money away from you for that home. If you have taken a mortgage, it is taking money away from you as well. So it will be more of a liability up until the point where it's not taking money away from you, and it only becomes an asset if it's bringing money in for you. Yeah. Then when you're thinking about wealth, you see, wealth is you are looking to take opportunities so that you can grow your portfolio. And for you to take these opportunities, it means that you need to be able to have money, some cash in hand, so that when Linda tells you there's an infrastructure bond that we need to invest in, it's giving a 17% return per annum, it is tax-free, you have money that you can say, yes, this is money we can easily liquidate, and we buy that infrastructure bond so we can add it to our portfolio. But if you think about now owning a home, and I'm coming to you with that opportunity, it will be very hard for you to start thinking, okay, so then that does mean I sell my home. So it's not, wealth is not just about ownership. It's also about cash flow, which is very key when it comes to building your wealth. Then again, the other thing we think about, or rather why I say owning a home does not automatically mean that you're building wealth, it's because of the higher mortgage payments. So if you've taken a mortgage and you're doing monthly repayments and it's taking up maybe even 60 or more of your income, then that means you have less disposable income for you to be able to cover any other, you have less disposable income for you to invest in any other things. Because again, remember, yes, you're paying for the mortgage, but you have your own basic needs that you need to be catering for. So by the time you are left with anything, it's hardly anything much for you to say, this is what I can save and this is what I can invest in. So it limits your ability to be able to invest and get returns in other investment opportunities. And as I said, when it comes to wealth, liquidity matters a lot. There are different opportunities that come every other day for you to be able to improve your portfolio, for you to be able to optimize so that you're getting the best benefits from the best returns out of your investments. And you're only able to do this if you have you are liquid enough to be able to take it. So liquid doesn't mean you have money in your wallet just sitting and waiting for an opportunity. It just means you've put it in a vehicle that you can easily convert that money into cash to be able to put into the investment opportunity. So that also matters a lot. So, and I hope with this we are able to see that in as much as, yes, owning a home is good and we look at it as a sign of wealth, it's also good to see that on the flip side, at most times, it holds up, it sits on a lot of money that we could be able to use this money, invest in something else that will be able to generate us some good returns. And at times, maybe when those returns are what will help us to come back and be able to buy a property with less pressure and less stress. And I thought, let's just try and dig slightly deeper into our mindset as Kenyans on home ownership, from culture to pressure and the strain it actually causes. Cultural expectations is just basically, you're always told, as you get into adulthood, because signs of adulthood means now you're out on your own, you're independent, which is good. But then most of us go like a notch higher and say, okay, now you have to own a home. Yeah, you need a place that you can fully call your own. And that becomes like a sign of success that, kufika ni, I have this house, I bought this property and all that. So if you are one of those who say, okay, I'm not ready to buy a home, or I don't foresee myself buying a home, especially in the urban areas and all that, then people just like, it seemed like as a sign of you're failing to provide for yourself and your family, or you are a poor planner. That is why, you're not able to put money together to buy a home. And all that. And then there's also the emotional and social pressures, because sometimes we are in these groups of ours, maybe there are people we went to campus with, and now everyone is out here with families and all that. And then we reach the point where now everyone just starts, people are now buying homes. So we have gotten good jobs. We've gotten married, people are having kids, we've done baby showers, we've done bridal showers. The main one is called what? No, those the male bridal showers. Then now baby showers. Then people have bought cars. People have bought land. Then we reach the point where now people are starting to buy houses, and we start feeling the pressure now that, hey, even me, I need to be able to. When we are sitting in this setup, even now I'm able to say, that house of mine. 1, 2, 3. So it becomes like a sign of progress. So you're proving to other people that even me, I'm progressing. And then there's also the idea that, because as Kenyans, as Africans, we have an ancestral land. And that land is always like, I feel like I want to build, and I'll confess, I'm part of these ones. I have to build I call it, that's my home there in the village, so that when I retire, I can go and sit and do all this. So there's a lot of attachment to that, even though sometimes if you look at it, you might have like a very vast piece of land, and keeping all that land may actually not make financial sense. At times we're not even doing much on that piece of land. We're not farming on it because maybe you are based in Nairobi. Your land, like some of us, is there in Kisumu, Kakamega. To make the trips there, you're going by road, it's 6-7 hours. So even if you're farming there, it's going to be a lot of just physical and emotional turmoil to get you there and back. But the fact that you're saying, I cannot do anything much with that land, I can't sell it, or I don't want to lease it out because it's ancestral land. I have to keep it so that I can say I'm going home. But it's not getting anything into your pockets for you to be able to invest. Then there's the bit for, if you just look at the mortgage rates that we have here, if I want to buy a home right now, even I would be paying to a tune of between 13-14%. on that. Then based on all the other deductions that I'm getting, and I'm adding mortgage repayment to that. So it really puts a lot of pressure on the money that I have. And then it's also for a very long time. So I'm taking a mortgage for the next 15 years, 20 years. You can imagine, one, I'm not so sure about the job that I have. If I'm going to keep it for that 15, 20 years, nothing is guaranteed, whether you are self-employed or you are employed. Self-employed, God forbid, something would happen to your business. If you're employed, the company could decide it's restructuring and that's it. And usually when that happens, they would give you maybe like a grace period of 3 months, 6 months for some. And then after that, your mortgage goes back to market rate if they had given you at a staff rate. So when you think about all this, you just see a lot of pressure piling on someone just for me to say that I own, I'm a homeowner. And sometimes it's just trying to think, is it really the true sign of wealth? Because true wealth is a power for me to be able to choose, not just to survive. Because if I'm dealing with all those emotional strain, cultural expectations, pressures on my income, I'm basically just surviving. I don't have the power to choose. I might not like where I'm employed, but I find it so hard to move because I'm thinking, are they going to be able to take up my mortgage? Are they willing to pay me as much as I'm earning? So that I can be able to pay my mortgage, or finish that construction for the house that I've started. So you find that you are basically just surviving and you don't have control over the choices that you look at. And basically true wealth is what gives you control. It gives you freedom. It allows you to make financial choices. It's what we call financial freedom. You choose not based on what is, but you just like, okay, I can be able to live where I want. I can be able to afford this house, do the trips I want to do, be able to provide for my basic needs without really thinking about where it's going to come from tomorrow. Then there's also the bit for liquidity, and that's your financial independence. Then there's also the bit for liquidity, where you're thinking, if I have bought this, I've put money to buy this house, and I need some money, as we were saying, will I be able to get this money to invest, to put in that investment that I'm thinking? If it's tied up in land, in home, or in investments that you're not able to sell, then there's that opportunity cost. You're not able to take up this opportunity and get the return that it's offering because that money is already tied in that home that you had put your money in. So in as much as it's always good to think that wealth is not really just what you own, it's what you can actually use to grow your investments. So it's thinking beyond, I have it, yes, but what are the chances? How flexible am I in taking up or even considering other choices that I want to be able to do? If I've bought this piece of land, I've built there, basically I'm telling myself, this is where I'm going to live. Yes, there are those options where you can say, okay, fine, I don't want to live there in Kamulu, though I've built, my children are going to school this other side, so I would want to rent that there and maybe come and move to Kilimani or to Westlands so that they can go to the school of my choice and all that. But again, it's also thinking the rent that you'll be fetching there, is it going to be able to cover the house that you are renting here? So the whole flexibility and choice is very limited when you have put all your money into that property that you wanted to keep. Now, I want us to go and look at like the different investment options that we have when it comes to, so what else? So what are all these other options that we can consider that would help us at some point be able to maybe even come back and own this property with less stress and pressure? But before we do that, I always say, before you save, before you invest, it's very good to know where you're putting your money, who's watching your money, what's going to happen. If I need this money, how easily can I be able to get it? Because we've said wealth is liquidity. When an opportunity comes, I want to be able to take up that opportunity. And before we do that, it's always good to see who are the regulators, the people who are looking after this money that I'm putting in these investment options. Because of course, the first disclaimer I always give is make sure if you're investing in licensed and regulated products. That way, there is a procedure that you can follow when it comes to if you have a complaint about the service provider. If you want more information and you're not getting enough information from your broker or from your fund manager, you are able now to escalate it to, okay, so who's the next in command that I can be able to get that information from? It's always good to know that before you invest. Are they licensed? Are they regulated here in Kenya? So it's looking at, so who are these regulatory bodies? So if you're investing in Kenya, you're most likely to come across the Capital Markets Authority. Now, if you're investing in stocks, if you're investing in bonds and you're looking to trade these bonds, if you're investing in money market funds, what's called the unit trusts, if you're investing in REITs, real estate investment trusts, we'll talk more about it a bit later. And if you're dealing with investment advisors, if you're dealing with the fund managers, if you're investing in the money market funds, all these people are regulated by the Capital Markets Authority. And the purpose of CMA is to protect you as an investor and provide you with transparency when it comes to the products that you're investing in. So if you're putting your money in an MMF and you're looking for information about, okay, so what really are money market funds, the types of money market funds, you can get that information from your fund manager, the one that you're looking to put your money to save your money with, or you can also get that information from the Capital Markets Authority's website. So they are all regulated, and Capital Markets Authority will always do audits, inspections to just make sure that the money you're giving them, they are actually investing it in the allowed securities that they are, because they are those securities that they're allowed to invest in. Then there's the Central Bank of Kenya. So this one, if you're investing in bonds, you'll always see on a monthly basis. The other day they would float and say, for this month, we are offering these bonds for local investors to be able to bid for them. So you'd see them coming through, and then they regulate the banks. So when you put your money, Central Bank is there to make sure that your money is safe. If you're investing in T-bills and bonds, then that goes through the Central Bank of Kenya. Then there's the Retirement Benefits Authority. These ones, when you're part of a pension scheme, a retirement fund, all the pension administrators. So with them, they're really keen to make sure that this money that you will need later in retirement is being invested properly and with the licensed intermediaries as well, the licensed advisors. So of course, again, if you go to the RBA, you'll be able to see the bodies that are licensed and regulated by the RBA. And then there's the Insurance Regulatory Authority. This is also very important when you're thinking about protection. Protection means you are building wealth, yes, but you also want to be able to protect that wealth. You don't want to reach a point where you have invested so much and then you get an emergency, and because you need money now, you don't have an emergency fund, you've put your money in all these other investments, you have to start liquidating them. At least for an insurance will be able to protect you in terms of if anything happens to you, the people you've left behind, you've left them something. If you're building, now we have term policies where you're able to put your money for a period of time, pay premiums for a certain period, and at the end of that, on maturity, they're able to pay you back inclusive of the bonuses. So all those insurance products, whether you're taking up whole life cover, term cover, if you're taking up last respect, if you're looking at medical, so all those insurance products, the insurance companies, insurance brokers, all of them are under the Insurance Regulatory Authority. The other bodies that you're likely to come across, especially if you're investing in stocks, would be the NSE. So it's not really a regulator, but it's the one that provides the platform that you're able to invest your stocks through. You would open an account to the broker, but we're able to do it through the platform that is provided by the NSE. And then it works under CMA's oversight. So as a stocks investor, you are likely to come across more on the NSE, Nairobi Securities Exchange, when you're doing that. If you have savings with a SACCO, there's SASRA, which regulates the deposit-taking SACCOs. that. And again, it's also very good to just make sure that even if you're doing your savings through a SACCO, you try and do that with the licensed SACCOs. So those would be the bodies that you'd come across when you're trying to build wealth, as you work towards maybe that home ownership or any other investment goals that you have, right? So I want to take us through what I call a framework for building wealth. Again, I say wealth is not built by just putting money aside once and that's it, but it's finding ways to make that money that you're putting aside serve your purpose, and it serves your purpose consistently. So you have to also give it time. I normally tell my clients, wealth building need money. So you need time to understand where you're putting your money, why you're investing there instead of, or why will I invest in bonds instead of investing in stocks? Why would I put my money in money market fund instead of putting my money in the bank? Knowing very well that even that money of mine that is in the money market fund, it's actually sitting in the custodian bank, which could even be the bank that I bank with, So it's getting to understand that. And can I do it on a consistent basis so that this money that I'm putting aside is helping to serve the purpose that I want? So if I'm putting this money and I'm buying that property, how is this money that I'm putting aside and where I'm putting it helping me to get to that target of owning that property? Yeah. So you're thinking of you're laying the foundation first, and laying the foundation is you're looking at your money as a toolbox. This money needs to work for me. If I am in this toolbox of mine, I have a hammer. This hammer needs to be able to do some work for me to maybe do just a nice level or fix this nail that is coming off and to be set properly. So you're thinking of that money as a toolbox to be able to help you through that your wealth building journey, right? And then now from there, we move on to the next. And this is, that foundation also includes you being able to get as much information as you can when it comes to the investment options that are there. You see, I said, before you put in your money, get to find out who is watching this money of mine, who's regulating this. And that means you're taking time to be able to understand the different investment options. So whether it's watching podcasts, whether it's linking up with an investing coach like myself to walk that journey with you and tell you stocks, this is about stocks, bonds, this is about bonds, rates, this is about rates. Then maybe this is where you need to start. And then from this, step 2 would be this. So you're investing in that first, building that foundation of your knowledge. So you don't have to be an expert, but you need to understand this journey, because at the end of the day, it is your journey. You're the one who's working to build that wealth. Us as investment advisors will come in to just guide you through that journey. The second step in that wealth building journey, now we've gotten the information, we have the financial literacy skills that we need, is to now protect ourselves. We're thinking, I want to start this journey, but I also don't want to start, and if an emergency comes, then I go back to square one. So basically, you'll be looking, can I set up an emergency fund so that I will be putting some money aside here to build my wealth slowly, but I am also cognizant of the fact that if anything happens 3 months down the line, at least I have some money without having to sell this bond that I've bought or these stocks that I have bought. So you're putting money in an emergency fund. So if my recommendation, if you're single with no dependents, work with, I would say 6 months of an emergency fund. And this is basically saying, if I was to lose my job or my source of income, I own a business, if I was to be in a position where I'm not getting any income from the business that I'm doing or any salary, how long will I be able to survive? Or what are my basic expenses that I have to cater for? I have to cater for my house, I need to pay some elect, things that will keep you comfortable enough for you to be able to get another source of income. How much do they cost in a month? And then now work that times 6. You don't have to have it outright. You can build it slowly. That protects you from having to sell off any investments that you have done before you before you are ready to do so. So you have some emergency fund that will build. If you have a family, work with, if you have children in school and all that, work with 9 to 12 months, because then even though you're here, you don't have a source of income and all, you will still need to pay that school fees and all that. So factor all that into the emergency fund, so it can protect the investments that you're building. And then 3, it's just get clarity. We want to build wealth, yes, but we want to build it in such a way that we understand what am I building that will be good for me for the short term, which is between now and maybe 3 years. What investments am I building in this portfolio of mine that will be for the medium term, which is maybe up to like 9 years or so, and about 5 to 7 years or so. What is it that I want to build for the long term? Yeah. So you are looking at, I want to put some money, let's say if it's in a bond, I'm buying a short term, I'm buying a 5-year bond, because that's part of my medium term goals. It's going to help me something that I'm looking to achieve in the next 5 years. If I'm buying a 10-year bond or a 12-year bond, then I am looking at it from a long-term perspective. If I'm buying stocks, am I buying them so that I can be able maybe to get some capital gains in 5 years? Or am I buying them so that I can keep buying for the next 10 years or so? So the dividends I'm getting from these stocks keep increasing the more I'm increasing the stocks holdings that I have. So that's the kind of clarity you need, so that even as you're looking at building this and saying, you know, in 10 years time, I want to have a portfolio that has this much in bonds, this much in stocks. I have an emergency fund that is compounding in that MMF, so that then I can now maybe even just look at the passive income that I'm getting from this to help me now start doing, maybe start owning that property. Yeah. To the point of maybe even that passive income becomes now money that you can be able to redirect and reinvest in acquiring a property. And that becomes the clarity that you need. Then from there is you're looking at, can I match the money that I have with all this? So from this money that I have, how much am I allocating? What percentage do I want to allocate into the emergency fund? What amount am I going to allocate into maybe building my stocks portfolio? How much money am I going to allocate into building my bonds portfolio? Because you can be able to do that, or maybe just do 1 or 2, and then later on, once you start getting some returns, so you can say, let me buy a bond first, and then I would buy the bond. And every time I'm getting the coupon from the bond, I take that interest that I've gotten from the bond, securely, I take it back, and now I start buying stocks. So you see, the bond is helping me to now start buying stocks with that. So you align this money that you have with the investments that you're making, because you know, even these stocks, I want to get them to a point where I want to buy ABSA to the point where in 5 years, I will have 20,000 shares. If these 20,000 shares, if maybe in 5 years they declare dividends and even give me just 4 shillings for every share that I have, I know I'm looking at close to 78,000 there, less the 5% withholding tax. So that's the kind of clarity. When you have that clarity, you're able to match your money to that clarity. And then again, as I said, the 5th and also very important is you're building this, but you want to be able to protect it. So look at what is that can happen to me that will make me lose out on this investment that I'm building. If I'm building this investment and I'm saying I'm giving myself 10 years to be able to get some returns from these investments and redirect that investment to buying a house. What can happen to me between these 10 years that can actually inhibit me from realizing that goal? If I get sick and I don't have a medical cover, then that means medical is very, very expensive. I will need to be able to maybe now either solicit funds from family and friends, but most of the time it gets to a point where you have to liquidate what you have built. So then that means I will have to do that. So I have to look at, then can I look at the options I have when it comes to medical cover? If anything happens to me, or maybe like let's say I'm in a family and my husband is a breadwinner, so he's taking care of the basics. The money that I'm making, I am putting it in investments. If anything happens to him, if anything happens to me, then that means we are losing one source of income. So then, do we need to be able to cover ourselves for that? So I would be looking at, let's look at life insurance for both of us. If we are looking at, we want to build this wealth, and you also want this wealth to be built in such a way that it can be passed on to our children and our children's children, then that means we have to start preparing that. And preparing, for me, I'm very keen on, as I say, finance for families, getting the kids. Preparing is not just saying, okay, I'll set up a trust for them. It's preparing them as well, getting them to understand. So how do you manage money? How do you make money in the first place? How do you price the value that you're bringing to the market so that you are paid the right amount? How do you manage this money that you're paid? How do you save for the next? How do you invest this money? So as they grow older and get to the point where they become independent, they already have these skills and they're able to do that. Because you also don't want, you want to protect your investments in such a way that you don't toil and build a good portfolio, and you reach a point where if it's handed over to them, they spend all of it because they do not understand the value of growing what is being passed on to them. So now that you start looking at estate planning. So I would have a will so that at least I've left information on how I want my property to be distributed. And then I have a trust where this fund is, all these investments are kept under one vehicle and is able to still grow, and but the benefits are passed on to my dependents. So it's looking at all this from, one, you lay that foundation, you protect yourself for the near future so it doesn't inhibit you from investing. You get clarity on what you want to do in the short term, in the medium term, in the long term, and then you get to match your money for all these investment goals that you have. And on top of it, you make sure that you're protecting this money. And as I said, so most of those investment options you'd be looking at is you're looking at, can I invest in bonds which will pay you periodic income twice a year, fixed from onset to maturity. Every 6 months you'd get some money in. If you're investing in stocks, you're investing in companies, you're getting a shareholding of the company and you're able to gain dividends. So anytime the company makes profits, part of that profit is shared to the shareholders and you get a portion of that. So if you keep growing the stocks that you own, the number of stocks that you own, that means every time they will be paying dividends, you'll be getting more in terms of dividend, and that counts as your passive income. Yeah. And now that becomes more flexible ways for you to start building wealth. So in as much as, yes, that home looks all nice to say, unajua huku ni kwangu, I'm not paying any rent to anyone, it feels very nice. But again, is to think right now, where, just ask yourself, where you are right now, is home ownership still worth it? Am I doing this to grow? Am I doing it to feel secure, or am I doing it to please others? Yeah, because you want to have that home and you want to have it as part of your wealth and make that wealth sustainable, not something that's going to in between to give you stress. So not pressure, just purpose. And one way to know is looking at, so if I was to buy a home right now, what am I going to gain and what am I going to lose? So of course, yes, I'll be gaining the stability bit where I'm thinking it is mine. Ata, mbele nyuma, when I don't have anything, I can just sit in this house. People who say, ata kama ni kukula chumvi nitakulia tu hapa kwa nyumba yangu, lakini ni yangu, all those and everything. So you have that, and the pride of being able to say, yes, culturally, people will see like, hey, they have a home, a beautiful home at that. That one has planned themselves very well. They have reached, they have achieved. Then you also get to avoid the rising rental costs, because if you're renting, then that means the rental rates will keep fluctuating, and you'd have to, at most times, up the rent that you're paying, dependent on where you're living, if you would not want to move from that area. And then there's also the long-term appreciation bit, in some areas. Maybe you've built your home there, a school comes and sets up there, a hospital comes, government decides to do good roads, and suddenly the value of your property goes up. So at least there's that appreciation aspect of it as well. But on the flip side, it's also to remember that it's very capital intensive. It's very costly for you to build. To say, I'm going to put money aside to buy this property or to construct this property, you would need to put a lot of money down. Even the maintenance bit is also quite costly because you have to think whether you're living there or renting, the rates you need to pay. Any repairs would be you doing that and all that. And again, we talked about, so we've put this money there, a good chunk of money, that now that capital is tied there. Then that means if there are any other investment, if there's an infrastructure bond that has been floated, if there's an IPO for a very good company that is coming through, you will not be able to participate unless you have money, because then you are not easily able to sell that property to take up. Illiquidity is, again, as we said, it's very hard for you to access the funds once you've tied them in the property. If you want to take, it will be very hard for you to access cash, either to take up or to deal with any emergencies if you do not have an emergency fund, compared to if I have stocks and I have an emergency, I can be able to sell those stocks. Hopefully, I will not be selling them at a loss. But as you said, it's very good to just set up an emergency fund. And so if you look at that, if at all this now on a personal, because you say finance is very personal, so just getting to understand where you are, seeing what you'll get and what you lose, you'd see, am I ready then for home ownership now? And part of what would help you to make that decision is, one, have I already built my emergency fund? Is my income stable and predictable? And income, this is all income, not just income that you're earning from either your job or your business. This is also passive income. So have I invested in liquid growth assets? Do I have some money in that MMF? Do I have some stocks that at least the companies I've invested in are looking, the projections are quite good, their fundamentals are good? Have I invested in a bond that is paying me some fixed amount of passive income every 6 months? So if I have that, then it will make sense for me to say, okay, fine. So the next step for me would be to look into home ownership, and as well see, can what I've invested in help me to be able to get into that home ownership bit, right? Now, for those of us who might be feeling like, hey, okay, I'm trying to tick these boxes, but I'm not seeing, I've not ticked all of them, or maybe I've just started out. So then what are my options? And I still want to have a bit of real estate in my portfolio. I want to say, yeah, I've invested in a bit of stocks, and I'm still investing. I have a bond, and I'm waiting for more so I can invest further. I have an emergency fund. I've put some money in a money market fund there, and now I want to put real estate, but I don't have the millions that are needed for me to be able to say I own this property or this apartment. So the option that is there is what we're calling the real estate investment trusts. And this is where VUKA comes in. So what basically is it allows you an opportunity to invest in real estate properties without actually buying the property. So it allows you to invest in like the offices, the malls, the apartments. You can imagine how many millions, close to billions, that takes to be able to bring up those apartments. But you will be able to pull in your money, and your part of your money is used to, either construct these properties or buy them without you having the stress of buying that property and managing that property yourself. Now, these properties are mostly constructed or bought for income generation. Part of the income that those properties generate are passed on to you as part of the pooled people. We all came together, we brought the little money that we have, and that little money was pulled together into this large sum that was able to construct that apartment. Now, that apartment has tenants. These tenants are paying rent. That rent now is coming as rental income. Because now we are unit holders in these apartments, we will be paid, part of that rental income is paid back to us, as investors in that property, based on our unit holding. How many units do you have, and then what dividends are we paying for that? So you're able to earn from that apartment, the rent they are getting, without being the one who's buying that property. And that's what our collaborative partner for today does. So VUKA is a platform that allows you to be able to do that. So you're able to join in, sign up, And from as little as 5,000 and incremental, just based on your financial capacity, now you're able to put in any funds that you have from 5,000 shillings going onwards on a regular basis. You could make it a monthly thing and say, every month I'm going to put maybe 5,000 or 10,000 shillings based on your budget. And that now allows you to buy more and more units into the properties. Then from there, you're able to earn passive income. So these properties that the Kwetu, Kejani, and most of us have seen, the students' housing projects, they are paying rent for those properties, and part of that now comes back to you in the form of passive income, in the form of dividends twice a year. In terms of liquidity, again, we said wealth building means we need to be liquid, so then you can buy or sell your units on the platform if you need. The price will be there based on the pricing of the day. So if you've invested in stocks, it's actually a very easy process. It's basically how it looks like when you're investing in stocks. You don't have to stress about, okay, now which roof is leaking, or we need to fix this and that. That is done by the company. So you have put money in this beautiful project, but you are not going through the pressures and the stresses of trying to make sure that but you're earning some return from it. It gives you, from their site, you can actually get very clear, transparent information on where this money is being invested, the kind of projects they have, the occupancy rate and all that stuff. So it becomes very easy for you because it's very at least affordable and flexible in terms of how much can I put. If I have 10, I can put. If I only have 5, I can start with that 5 that I have. So I know with that 5, I don't have to own the building so that I can earn from the building. That 5 that I have now can be able to help me add that to my portfolio and earn some little passive income from that as well. Yeah, and for me, I think, just in conclusion, that's it. When we are looking at building our wealth, we want to build wealth without pressure. We don't want it to be a stressful journey, because honestly, when you're investing, think of it as a long-term journey. It's not something you do once. The things happen. The stocks will be good this time. In maybe in the next 5 months, the bond rates, the rates will start going up, and maybe people now will start moving again more to the bond market. So you want to be liquid enough so that if there's any opportunity, if there's an IPO, I hope there's one soon, you're able to take advantage of that. If there's a company that maybe some research has been done on it and the fundamentals are looking good, or they've undertaken a project and you're seeing this project is going to earn them good money, and you want to be part of the ones who are celebrating that profit in form of dividends, you want to invest in that company, it's listed, you are able to do that because you are liquid. So one is, it's always good to start thinking beyond the tradition. Yes, home ownership is good. Yes, people at home will say, yeah, tunataka ukuwa na nyumba. Be serious. Yeah, get a house. I'm seeing so many of them be serious, get some land, all that. So you need to start thinking beyond the tradition and thinking what works, what will work for you, where you are with the financial capacity that you have. And then you build that strong financial toolbox. As I said, your money is supposed to be working in your favor, not you. We don't want to work for money forever. We want to reach a point where we can say we have financial freedom, where we are able to finance the lifestyle that we have, the basic needs that we need. We can travel, we can give without really worrying about next. So that would be the ideal. But even if we don't get to that ideal, we want to get to a point where we are comfortable enough to be able to do that. But we need to make sure that our money is a tool to get us there. Then you play smart when investing. Of course, invest in licensed, regulated products. Get to understand, why should I invest in bonds instead of stocks? Or why should I put my money in stocks instead of just leaving the money to sit in a bond for the next 10 years? But because where you're putting your money will be dependent on you personally, what your investment goals are, your duration, and what we call your investor profile. So one of the first webinar we had done with VUKA was on understanding your investor profile. It's on my YouTube channel, Finance for Families. You're able to watch that as well and get to understand. So as an investor, what is my profile? What goals do you have? What is your risk tolerance and all that? Then you're able to just invest wisely. And then you don't just invest and sit. Again, you see, you have to be able to look for ways to grow your wealth without the pressure. So how can I be able to do that? I make sure I'm investing in the right things, and I'm also protecting myself for my own peace of mind. If I know I have an insurance cover, if I know I have planned my wealth in the form of teaching my children about money, I also have a will somewhere. I'm trying to see how to set up a trust. There's also some peace that comes with that. And that becomes part of your wealth growing journey. I am building, but I'm also confident that if anything happens to me, my children, my beneficiaries are well catered for. Right. So for me, I think it's, if anything, for this would be like the 4 main tips I would give us to be able to work with, to build that wealth, to have that wealth be a key to a life that we can build. And of course, it's not going to be built in one day, but it can be built with consistency. And I will say, just do it, have discipline, consistency, and so long as you have clarity around what you want and you're willing to work for it, and if you feel like you need the guidance of like a professional to walk that journey with you, reach out to someone like me to walk that journey with you. You're able to attain it. Yeah. So we are doing time in the market. We are not trying to time it. We're doing time in the market. And I think with that would be my insights for the day. We are all looking to grow, but you see, again, even growing is, we are pacing ourselves with this growth, and we will get there. We'll get to the point where we can comfortably buy that house that we want. We can comfortably live the life that we want, but we have to give ourselves time and just do it on a consistent basis. So those are my contacts. You can reach me if you're interested to get maybe just more information about how to start investing in VUKA in detail. You can reach out to me and be able to just give you a call back and give you that. If you're looking at wealth planning, if you're looking at building your investment portfolio, or just financial literacy skills building, either yours or your family. So I do talks for even children, the young ones as well, families together, couples, or the whole family, just get them to understand how to budget. Do reach out. Just let me know. You can drop me a text and let me know what you'd be interested in, and then I can reach out to you. But with that, thank you very much. I am hoping, I was quite scared that 1 hour is a short time, but I am willing to take a few questions. Again, I don't know if I had mentioned, this session is recorded, so I am going to share it on my YouTube channel as well. If you get time, do listen to it or share it with a few of your friends and family members. And if anyone has questions, you can be able to reach out to me. But with that, thank you very much for your audience. You can share a few questions, either talk or just maybe chat if you have any questions. If I may ask, by just a show of hands, who already has a portfolio? Maybe just use an emoji. Who already has, maybe already investing in stocks, has either invested in T-bills or a bond, or VUKA. Oh, okay, good. Now, I don't know if Ken wants to talk, or he's agreed that he has. VUKA. Good. Lenya has VUKA. Ken has raised his hand. I don't know if you have a question, Ken? I think you can unmute. Oh, I am agreeing that I have. Okay, so he also has a portfolio, so that's good. Yeah, it's very good. I always encourage, I say, we don't have to start big. The goodness is when it comes to an investment portfolio, there are very different asset classes you can invest in, and you can start with the match that you have. So if you can put aside that five can either go into starting you investing in VUKA, that 5 can go into you starting to build an investment portfolio. That can also go into maybe you just putting that money aside consistently to the point where now you can get to a minimum of 50,000 and buy a bond. Yeah. Oh, there's a question from Faith Mbogo. How much are rates? Is it monthly or quarterly? So with the rates, you would get your dividends twice a year. Like right now, if you invest by the 30th of June, you'd be eligible now for the dividends that will be out around September. So rates taxed at 5%, the dividends are taxed at 5%, and that's a final tax. So it will come less that tax, but that's it. That's for rates, the dividends you get on rates, and as well the dividends that you get on your, if you invest in stocks as well, taxed at 5%. If you're investing in bonds, if you're investing in infrastructure bonds, those are tax-free, you don't get taxed. If you're investing in the fixed bonds, if it's a bond that is between 2 years and 9 years, you get taxed at 15%. And if it's a bond that is 10 years and more, you get taxed at 10%. Yeah. If you're putting money in a money market fund, it's also subject to 15% withholding tax. So when it comes to taxes for most of investments, that's how the tax is applied. Any other question? I hope I've answered that. So it's 5% for the dividends that you're earning from VUKA. And MMF is at 15%. Oh, what's the difference between having an MMF and REITs? So a money market fund is you're pulling this money and you're giving the professional here, who's the fund manager, the right to be able to invest this money on your behalf, get some returns from that, and then from the returns they get from the investments they've made, that is now distributed to you on a monthly basis. So the money that you've put in a money market fund earns interest on a daily basis, but it is compounded and now paid out to you at the end of the month. So when you've opened a money market fund, you'll see if you put the money at the end of the month, you'll get your statement, and at the end there you'll see how much interest that money has earned, or the withholding tax it's subjected to, and then the total. So if you don't withdraw that money, it compounds, meaning the money that you put, the interest that money earned starts now earning interest as well. Yeah, the next month. When it comes to rates, you're taking this money and you're buying units. So rates is more similar to buying stocks. So you're actually buying units in this company that has either built or constructed either apartments. Now, for the sake of VUKA, it's the Kwetu and Kejani properties. So you're buying units into that. Now, based on the number of units you have, when they announce, then they will base the dividends they're paying you on the number of units you have. In between, you can buy more units. So if you go there and I have 5,000, I can, on the platform and be able to see how many units can I buy with that 5,000 bob. So they're more similar to stocks than to MMFs. And then I will get that dividend. When I get that dividend, I have the option of reinvesting, using that dividend to buy more REIT units, or taking that money and saying this is part of my passive income. I normally recommend when you're building your portfolio, it's always good to reinvest that money that you're earning. So if you get paid that dividend, that VUKA, sends you an alert and says, we are paying dividends this September, they will be paying. then you would, the best option would be to reinvest that money, put it back, see if you can be able to add more money meanwhile as well, so you can get more yields. So of course, because at the end of the day, you get more and more dividends, the more units you buy. So you have to, the same with stocks. If I have 1,000, like let's say 1,000 stocks of Equity Bank, and they're paying 4 shillings, I would be expecting to get about 4,000 less 5% withholding tax. So let's say 3,900. Now, if I continue buying, if I get that 3,900 and I put it back and I buy more equity stock, then that means if by next year I have 3,000 and they give 5 shillings, I will be now getting about 15,000 in terms of dividends. So that is how I would want us to look at even the rates to see, can we buy more units so that as they are paying more and more dividends, we also are earning more and more in terms of passive income that we're getting from it. Yeah. But the MMF, the money that you put in MMF is normally invested by the fund manager. So they would either invest in commercial papers, they will go and invest in government securities and pay you coupon they'll pay you interest every month at the end of the month, and that interest keeps compounding. But the rate, you keep buying units. When they pay you dividend, that's when now you can reinvest the dividend to grow the number of units that you have. I hope that answers you. Yes. So the dividend that is paid out is normally, so with rates, they are mandated to pay out, I think it's 70% plus of the income, the rental income they generate. So with them, they have to pay out, a large chunk of it, as compared to just the normal listed companies who at times would not even pay out because maybe they'll reinvest that money, they plow back that money to grow. Maybe there's another project, or they want to go to another country, then they can say, instead of paying out this profit we've made, let's put it back into that project. But for rates, the rental income is now subject to. So when they announce in those 6 months, they'll say this is a match we've made, and out of that, they are mandated to pay at least 70% back to the unit holders. Where do you get the bonds from? Is it still CBK? Yes, it is. You need to open what we call a DOCSD account. It's free to open. You need your ID copy in soft, your carry, your bank account details. Then you'd go to the DOCSD account, DOCSD site, put in all your details, you're able to open the account. And once it's active, whenever there's a bond that you are interested in buying and it has been issued, it's been floated, it's available for purchase, you're able to do that. Yeah. But again, I will just mention, so when it comes to a bond account, for you to invest in bonds, the account is a CSD account, a DOCSD account. It's free to open, you don't get charged. If you're investing in stocks, if you want to invest in stocks as well, you'd open an account with a broker. That's also free. And for VUKA as well, if you require to open an account, if you don't have one and you want to open, send me, just share your details with me and I'll send you the account opening details and you're able to do that. But it's a very easy, seamless process that, again, after that just allows you to be able to put some money into the account and start investing. Or fixed bonds, so 10 years, anything 2 years to 9 years, 15% withholding tax. And it is on the interest, the coupon, okay, which is normally called the interest. So the withholding tax is on the interest that you're earning, not the money that you put there. So if the interest that you're earning in 6 months is, let's say, 20,000, that is what is going to be subjected to 15% withholding tax if that bond is between 2 years and 9 years. Any bond that is above 10 years is subject to 10% withholding tax. Yeah, I hope that clarifies it. Yeah, so 2 to 9 years, 15%. 10 years and above is 10%. Is the emergency fund considered part of the portfolio? Say it's invested in MMF. Yes. So my recommendation would be you would have at least two money market funds. One would be strictly your emergency fund. This is money you're putting in case you lose your source of income. You are able to put, and you have an amount that you know. So if I was to lose my job, and for me, I would be comfortable. Maybe I want to be comfortable for the next 3 months, 6 months. Then you calculate how much, and now that is the money that you put there, and strictly for only emergencies. And then you can have another money market fund, and this is like your opportunity fund. So this is where you're able to pull money. I might want to invest in a bond, but I don't have 50,000, or I want to buy a bond 200,000. I don't have that 200,000 right now. So what I would do is I would be putting the much I have into a money market fund. When I get to that 200,000, I will then move this money to go and buy that bond that I want. So your money market fund becomes like, so it becomes your money management tool. You park the money there, you keep putting the little that you have. When it gets to the amount that will allow you to invest, and get good returns on bonds, then you're able to channel the funds there. So that's what I would say. But yes, it forms part of your portfolio, both of them, because one helps to protect your portfolio. The other one helps you to take advantage, gives you the liquidity you need to be able to take advantage of the other opportunities. Yeah. But all these things that now, if you reach out, you can also be able to build into your portfolio for you. And I think with that one, I've taken 6 minutes of your time. I think we'd also started 5 minutes late, but I hope I haven't missed another question. Just to wrap up, which broker would you recommend? I would say if the bank that you bank with has a brokerage subsidiary, you would go with that. But for most, I think most of them are licensed. So if let's say maybe you bank with NCBA have a brokerage, you can open an account with them. Just make it easier. Maybe sometimes when you want to transfer money from your bank account to your brokerage account, if you bank with KCB also have, ABSA also have a brokerage account, CFC, Stanbic also have one. But if you're looking at standalone brokers, we have several. You have Standard Investment Bank, you have Faida Investment Bank, you have Dye & Blair, you have AIB, Axis, and most of them are very digital. So once you open the account, you get an online platform, and when you get access to the online platform, you are able to trade with that. Yeah. So I think that is it with that. Thank you very much. If you think of any other questions, do feel free to reach out either on my socials, Linda Makatiani, that's my number as well. Let me know how I can be able to assist, whether you're looking at wealth planning, if you're looking for someone to be your accountability partner, work with you through investing, or if you and your family are thinking you want to improve our financial literacy skills, you want someone to come and walk that journey with us, do reach out as well so that we can all grow together. But thank you very much for your audience today. And I think with that, we will end today's session. We'll keep you updated. I will share this recording, and as well I'll share it on email to be on my YouTube channel. So I'll share the link to that on email to everyone who was here today. And I think with that is, yes, thank you very much. And I hope to engage more of you on a personal level. Yeah. But have a good evening and see you hopefully on the next webinar. Asanteni sana. Thank you. Thank you so much. Thank you, Emmanuel. Thank you, Ezra. Thank you, Kakai. Thank you, Anne. Thank you so